Recently, the account Yi Chongzhen on X posted 2 long threads with detailed data and sharp commentary, systematically outlining the theory that China is on the brink of collapse. The threads were written from both economic and political perspectives, sparking intense discussions. At the same time, rumors regarding General Secretary Xi Jinping's loss of power have been circulating. The Hudson Institute, a well-known American think tank, also released a major report suggesting that the fall of the Chinese Communist Party is imminent. All this information seems to support the idea that the CCP's regime is nearing collapse. Today, we'll delve deeper into the systemic crisis facing China's economy and the possible political shifts within the CCP regime. Yi Chongzhen points out that while China's economy prides itself on being robust, it is already riddled with internal issues. The core problems include a debt crisis, deflation risks, foreign exchange troubles, and structural flaws. In short, China's economy is now in a state of irreversible systemic collapse. 1. The debt trap. Yi Chongzhen highlights the first fatal piece of data. China's financial enterprises have total liabilities approaching 500 trillion yuan. This means that at least 20 trillion yuan in interest will be generated annually, far exceeding corporate profits, government tax revenue, and the limits of the real economy. It is enough to shatter any economy, and it's irreversible. Financial enterprises include banks, securities, insurance, and other types of financial institutions. According to the People's Bank of China, at the end of 2024, the total assets of China's financial institutions will be 495.5 trillion yuan, a 7.5% increase from the previous year. The liabilities of the institutions will reach 452 trillion yuan, also up 7.5% year-on-year. In 2024, China's GDP is projected to be 135 trillion yuan. This results in a debt-to-GDP ratio of 335%, far surpassing the 90% ratio of the US and Japan. This ratio not only reflects China's extreme reliance on debt, but also exposes its fragility. International experience shows that a debt-to-GDP ratio exceeding 200% is usually considered a high-risk threshold, and China's 335% is well beyond this limit. What's even more alarming is the debt growth rate of 7.5%, which means 30 trillion yuan will be added to the debt every year, over 1/5 of GDP. In comparison, China's GDP growth rate in 2024 is only 5%. This indicates that the growth of debt is eroding the economic foundation at an exponential rate, creating a debt snowball effect. Yi Chongzhen compares this to a nosedive. Collapse is just a matter of time. Next is government debt. In the first half of this year, the total issuance of government bonds was 13.5 trillion yuan, with 5.8 trillion yuan used to roll over old debt. In the first half of 2025, the increase in government bonds will be 656 billion yuan, a staggering 129.3% increase from the 3.34 trillion yuan of the previous year. The increase in government bonds accounted for 33.5% of social financing growth, meaning that 1/3 of the entire financial system's growth is supported by government debt. What's terrifying is that the government's tax revenue is only 25 trillion yuan, but it runs a deficit of over 6 trillion yuan each year. Some cities' annual tax revenue is insufficient to cover interest payments on local debt. Living on borrowed time forces local governments to keep borrowing new debt to pay off old debt. However, this Ponzi financing model is clearly unsustainable. Once the credit chain breaks, a systemic financial crisis will be inevitable. 2. Losses across all industries. The slow death of the real economy. Yi Chongzhen outlines another fatal issue in China's economy: the widespread losses across all industries. From railways, aviation, and energy to dining, real estate, shipbuilding, and automobiles, almost no industry is profitable. This is not a mere cyclical fluctuation, but a structural systemic crisis. In 2024, corporate profits will only amount to 6 trillion yuan, with the financial sector accounting for 50% of that. The remaining 3 trillion yuan amounts to just 0.6% of total output, likely adjusted profits. This indicates that China's economy's production capacity is severely insufficient. At the national economic level, there is no real profit. Most companies are losing more as they produce more. Real estate, a pillar of China's economy, has fallen into unprecedented turmoil in recent years. Since 2020, major property developers like Evergrande and Country Garden have faced significant crises, causing a sharp drop in the real estate market. Falling house prices, unsold inventories, and developer bankruptcies have become the norm. In 2024, China's real estate development investment will fall more than 15% year-on-year, with commercial housing sales area and sales volume down by 20% and 25% respectively. The collapse of the real estate industry has not only dragged down upstream and downstream industries such as steel, cement, and construction, but also led to a significant shrinkage of household wealth, further reducing consumption capacity. More seriously, the real estate debt crisis has directly impacted the financial system. The high leverage used by property companies has pulled banks, trust funds, and other financial institutions into the quagmire. If property developers cannot repay their debts, bank balance sheets will face immense pressure, potentially triggering systemic financial risks. Apart from real estate, other industries are also trapped in the mire of losses. losses. Infrastructure sectors like railways and aviation, burdened by heavy investment and low returns, have long relied on government subsidies to stay operational. The energy sector is squeezed by both international oil price fluctuations and domestic price controls, reducing profit margins. Consumer industries like dining and retail are struggling under deflationary pressures and declining consumer spending. Yi Chongzhen particularly highlights that the root cause of the losses in the real economy is the shrinking profitability under deflationary pressures. In a deflationary environment, businesses cannot pass on costs through price hikes and must reduce production or lay off workers to survive. However, this vicious cycle further exacerbates economic contraction, leading to rising unemployment and shrinking consumer demand. Chinese economic data analyst Lao Man recently stated that according to data from the National Bureau of Statistics, the loss rate of large-scale industrial enterprises has risen from 11.9% in 2013 to 22.8% in 2024, and it's expected to surge to 30.4% by May 2025. If this trend continues, the loss rate could reach 40% by the end of this year. In such a large-scale loss scenario, the macroeconomy will not be able to sustain itself, with cash flow breaking down and production order collapsing at the brink. Another alarming set of data reflecting the level of industrial losses is the industrial capacity utilization rate. In 2016, the industrial capacity utilization rate fell to a historic low of 73.8%, indicating significant economic problems at that time. To avoid an economic collapse, the Chinese government introduced a policy to reduce inventory in real estate, artificially pushing up housing prices and boosting industrial capacity utilization across upstream and downstream industries. This led to a steady industrial capacity utilization rate of about 78% from 2017 to 2021. However, after the real estate bubble burst in 2021, the industrial capacity utilization rate began to decline, stabilizing around 76% from 2022 to 24, a 2% drop compared to the previous 4 years of soaring housing prices. By the second quarter of this year, amid the intensifying US-China trade war, the industrial capacity utilization rate further dropped to 74%, nearing the 2016 low. The data above shows that over 1/4 of industrial enterprises are idle, and over 30% are operating at a loss. Lao Man suggests that this situation is even worse than the global Great Depression of the 1930s. Against the backdrop of severe economic stagnation, the last pillar holding up China's economy, fixed asset investment, has also shrunk. In the first half of 2025, the investment scale is 25 trillion yuan, a mere 1.3% increase year-on-year. The official claim of a 2.8% increase is a fabricated figure, as basic division of the data from the Chinese National Bureau of Statistics makes this clear. What is even more alarming is that monthly investment growth has been steadily declining. In February, the growth rate was still 3.5%, boosted by the trillion-yuan special government bonds, which gave local governments money to restart interrupted infrastructure investments. By March, it dropped to 2.8%, then 1.1% in April, 0.7% in May, and by June, it fell to negative 1.2%. This shows that, under extreme economic stagnation, statistical departments can no longer manipulate the data and are now reporting relatively true investment figures. Undoubtedly, even these numbers have been adjusted. Another indicator of real fixed asset investment is the cement production volume. In the first half of this year, cement production fell 4.1% year-on-year. Therefore, the real investment in construction activity is likely to shrink significantly. 3. The final blow in the US-China trade war. Since 2018, when Trump launched the US-China trade war and raised tariffs on China by 20%, this level of tariffs had already been unbearable for Chinese export businesses. The escalation of the tariff war in 2025 is seen as the final blow to China's economy. After the US continued to raise tariffs on China to 245%, 2 rounds of negotiations were held in Switzerland and London. The Chinese government was forced to fully compromise, abandoning all countermeasures, including the rare earth export ban. Eventually, tariffs on China were stabilized at 55%, while China maintained a 10% tariff on US goods. This high-intensity tariff impact pushed China's economy to the edge of fragility. The US government not only increased tariffs, but also significantly strengthened regulations on transshipment trade. It imposed harsh tariff penalties on traditional transshipment countries like Vietnam and Mexico, forcing them to block loopholes. At the same time, the US established a strict origin verification system, criminalizing and heavily punishing any attempts to falsify the origin of goods. These measures effectively cut off China's export evasion routes. China's economy is highly dependent on exports, with direct exports to the United States accounting for about 20% of total export value. Since 2018, in an effort to avoid the Section 301 tariffs, many Chinese companies have used Southeast Asia and Latin American countries to wash their product origins and export indirectly to the US. This made up another 20%. Combined, direct and indirect exports to the US account for 40% of China's total exports, a figure critical to the country's economic survival. The 55% tariff on Chinese goods will directly devastate China's export-oriented economy. When combined with strict limitations on transshipment trade, this has led to the sharp deterioration of enterprise loss rates and industrial capacity utilization, delivering a fatal blow to China's economy. Yi Chongzhen also warned of two imminent threats, the food security crisis and the foreign exchange crisis. These issues are not only economic in nature, but directly threaten social stability and national security. In recent years, China's agriculture has faced unprecedented challenges. Due to high costs and low profits, many farmers have abandoned their crops, and agricultural companies have gone bankrupt due to severe losses. As a result, the production capacity for food and meat has continued to decline. China needs to import about $300 billion worth of food and meat each year, accounting for a significant portion of global food trade. This high dependence on external sources makes China vulnerable to shocks in the international trade environment. Especially with the escalation of the US-China trade war, food imports could face greater uncertainty. If major food exporting countries such as the US and Brazil impose restrictions on China, or if international supply chains are disrupted due to geopolitical conflicts, China's food security will be under immense threat. What's worse, the true state of China's food reserves has always been opaque, with significant discrepancies likely between official data and actual conditions. The foreign exchange crisis is another major risk mentioned by Yi Chongzhen. In 2024, China's foreign exchange reserves were around $3.2 trillion, but most of this is used to maintain the stability of the yuan's exchange rate and pay external debts. As the US-China trade war continues, China's export revenues may further decline, while the demand for imports of commodities like food and energy rises. This will lead to a rapid depletion of foreign exchange reserves, and if the reserves fall below a safe threshold, the yuan could face a risk of collapse. Yi Chongzhen warns that the foreign exchange and food crises will create a vicious cycle. Once imports are blocked, domestic prices will rise rapidly, causing a combination of inflation and deflation, which could lead to growing social discontent. The depletion of foreign exchange reserves will further weaken China's credibility in international markets, accelerating capital outflows and economic collapse. 5. Population crisis, irreversible impact on the economy. The Chinese government claims a population of 1.4 billion, but estimates from various sources suggest the actual population may be under 1.3 billion, with some more pessimistic assessments even believing the number to be far lower. Regardless of the true population, China's rapidly and irreversibly declining population is already having profound consequences. Despite recent policies aimed at encouraging childbirth, profound social and cultural changes have taken place. Population aging has worsened, with young women showing less interest in marriage and childbirth, weakening the effectiveness of these policies. Combined with declining incomes, lower marriage rates, and a shrinking number of women of childbearing age, and nearly no foreign immigration, China's population continues to shrink, casting a shadow over its economic prospects. The aging population and decreasing workforce will further drag down economic growth, accelerating the country's economic collapse. The legitimacy of the Chinese Communist Party primarily relies on economic growth to gain the tacit support of the public. However, when the economy falls into decline, recession, or even collapse, and is unable to recover, people's livelihoods will be severely threatened, and the foundation of public support will further erode. Therefore, the foundation of this regime's legitimacy no longer exists. This is the root cause of all crises and the most fundamental issue. 6. Structural and systemic crises, a deadlock with no solution. Yi Chongzhen repeatedly emphasized that China's economic challenges are not cyclical fluctuations, but structural and systemic crises triggered by long-term policy errors and institutional flaws, making them hard to resolve through conventional methods in the short term. Lao Man further notes that China's economic predicament is not only an economic issue, but also a concentrated manifestation of the conflict between industrial civilization and centralized governance. Depends on open and fair markets, while centralized governance requires a closed political environment and hierarchical social structures. The sharp contradiction between the two, long-term coexistence impossible. Thus, the CCP is not only facing an economic crisis, but also a looming governance crisis, with a potential regime change becoming a reality. Recently, rumors about internal strife within the CCP and Xi Jinping's weakening power have been circulating widely. Former U.S. diplomat Gregory W. Slayton recently wrote in the New York Post, suggesting that Xi Jinping is losing his grip on power and recommending that Trump push him further. Slayton points out that Trump's war has had a real impact, weakening Xi Jinping's power and increasing the likelihood that his successors will be more favorable to U.S. interests. The U.S. and its Western allies must prepare for the impending changes in the world's second-largest economy. On July 16th, the Hudson Institute, led by renowned China expert Mao Zhu, held a seminar titled After the Fall, Planning for a Post-Communist China. And a group of senior experts agree that China is facing complex structural changes that are seriously undermining the long-term stability of the Communist Party regime. These challenges include an increasingly uncertain economic outlook, a more hostile international environment, and the rigid governance system caused by Xi Jinping's political centralization, which cannot adapt to ever-changing reality. While the CCP has handled various issues in the past, the possibility of a sudden collapse now requires the international community to assess whether it is adequately prepared to respond to such a scenario. Researchers made analyses and recommendations in 9 major areas. In the section on rebuilding China's financial system after the collapse of the CCP, economy, the researchers pointed out that the financial system under the CCP rule is highly centralized, predatory, and politically manipulated. Its essence is not to serve the market and the people, but to consolidate the CCP's power. Therefore, after the CCP's downfall, the financial system must be completely rebuilt, not just patched up. To achieve this, the new government in China must initiate 4 major reform pillars in the early stages of political transition, including capital restructuring, rejecting illegal or opaque debts from the CCP era, privatizing state-owned assets, and decentralization. The author emphasizes that if China is to truly transition to a market economy, it must fundamentally departyize, break monopolies, dismantle financial authoritarianism, and establish rule of law, transparency, and competitive mechanisms. This is a deep self-correction and a reconstruction of historical institutions. In the next video, we will conduct a comprehensive analysis of the potential collapse of the CCP from a political perspective, as well as the response measures from the international community. Stay tuned.